Warren Buffett's investing style works in 2024, will work in 2025, and will continue to work in the future. In this video, I will analyze this template, Warren Buffett in a nutshell. In case you don't want the explanation, you can just take a screenshot and leave this video, because I will just explain every step and you will have my point of view on this one. If you don't know me, my name is Christophe Nour. I've been investing in the stock market for almost a decade with a performance of 24% per year. And actually, this method, Warren Buffett investing style, is exactly what I do. And I can tell it's working because I've been doing this for years, will continue to do it for years. And even this week, I went to an investment conference and we talked about this exact method. Okay, no, let's not waste more time. This is investing like Warren Buffett in a nutshell. Okay, let me zoom in. Where can I put my face? Over here. Okay, Warren Buffett has had three influences, and these are these three gentlemen: Phil Fisher, Ben Graham, and Charlie Munger. So Phil Fisher and Ben Graham was the older generation, so these teachers. He said, Warren Buffett actually said that he is 85% Ben Graham, 15% Phil Fisher, and Charlie Munger was his lifetime partner. Recently passed away, unfortunately, in 2023. So you had these two teachers, let's say it this way, and Charlie Munger, his associate. And these three people gave him a perfect recipe, a perfect formula to be the best investor in the world. So okay, let's continue. What has Phil Fisher taught Warren Buffett about investing? Focused portfolio, long-term holdings, keyword, scuttlebutt investing. The key to investing for Phil Fisher is to do the due diligence, is to ask questions, maybe go and see management, do scuttlebutt investing, ask many questions, be a detective. Now, for Ben Graham, the key lessons was buy stocks at an attractive valuation, Mr. Market, margin of safety. The key lesson from Ben Graham and net at the time was to invest in cheap companies. Maybe regardless of the quality, but mostly invest with cheap companies at a good valuation, at a cheap valuation. So you have two keywords, Mr. Market and margin of safety. Margin of safety, that's very simple. That's if you think that the business is worth $100, you don't want to buy it at a full price, you want to buy it below. So if you think it's worth $100, you will buy at $50. So there is a 50% discount, 50% margin of safety. And for Mr. Market, it just means that the business is irrational most of the time. And there will be a lot of fluctuations. Even you are seeing it. If you are following stocks right now, if you follow my YouTube channel, we are talking about long-term investing. So I suppose you are watching some stocks. Maybe the earnings of these stocks grow 10% per year. But the stock price of these stocks don't go up 10% per year. They go up and then down and then up, down, up, down. That's a complete mess. The market is irrational. You have this fear and greed index that is moving all the time. So yeah, you personalize the market, and Ben Graham called this market Mr. Market, that is completely euphoric, completely depressed sometimes, so completely lunatic person. You want to take advantage of this lunatic person. You want to buy cheap stocks when Mr. Market is depressed, when it is pessimistic, when everybody is panicking. There is a lot of fear in the market. And you want to sell your position when Mr. Market is optimistic, when the prices are sky high, when everybody is happy. They go on CNBC and say, yes, everything is fine. All you see is green, Bitcoin at all-time highs, to the moon, this kind of environment. So you have two extremes. Pessimistic scenario, optimistic scenario, and it oscillates like a pendulum. This is Mr. Market, completely lunatic person. Okay, that was for Ben Graham. And the third person is Charlie Munger. The lesson is invest in companies with long-term sustainable competitive advantage. The keyword is economic moats. You want to invest in superior businesses, superior business models that will continue to be superior in the next 20 years. This is very simple, but very hard to see in your daily life, because we are all tempted to invest in the next big thing. You have this shiny object syndrome. Charlie Munger recommends to only invest in a handful of companies, not a lot of companies, concentrated portfolio with superior businesses, superior stocks for the very long term. So they must have an advantage, a moat. Okay, by the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of this video. Out of these 3 mentors, friends, there are 3 final understandings. Buy for the long term with proper due diligence, buy at the right price, so you want a margin of safety, and buy right stocks that will compound at a superior rate of return because you invest in superior companies. Now, how to identify these big, beautiful investments? You can check several stuff. You can check 4 key elements. The first one is understandable business model. You want a simple business that fits within the circle of competence. That's your circle of understanding. If you are not able to pitch the company, to explain the company to a child, it's because the company is too hard. So just invest in simple companies. Apple, they sell phones, laptops, and they have some apps, some software. You sell Coca-Cola. Everybody knows Coca-Cola. You can pitch Adobe with Photoshop and softwares to improve the quality of image, some editing to make movies. Quite simple. You can invest in, I have Monster Beverage in mind also, but that's pretty similar to Coca-Cola. You can invest in Ferrari. So they sell cars. So that's very simple. You can pitch this investment in 2 minutes to a 10-year-old child. First one, really important, understandable business model. Don't follow the other steps if you don't have this first one ticked. First, understandable business model. The second one is in-depth analysis of business model from operation to financials, from sustainability to valuations. Yeah, everything. You want to be good with the numbers. So that's some proper teaching. That's what we do with our students. We teach them the right tools, what is important, what is not important, so that they know the key financials, key metric, and in 2 minutes they can say if an investment is good or not. So TLDR, you want revenue to grow for your business, for your stock. You want the earnings to grow. You want the earnings per share to grow. You want a healthy balance sheet, so a lot of cash, not a lot of debt. This is all the things I teach my students, and this is how to analyze a stock in 2 minutes. Okay, the next big element for identifying these perfect stocks is you want a company that is run by honest and efficient management. What does it mean? You don't teach that at school. You want management with integrity. That's really important. Maybe management is smart, maybe it is competent, but if they lack integrity, they will eat you, they will kill you, they will take all your money, and you will be disappointed as a shareholder. So you want a management with a lot of integrity. You want transparency and accountability. You want management to tell you when they screw up. You want management to tell you when they do mistakes. We did this acquisition, but it failed because of this. Okay, we will pivot. It didn't work. We will continue to do that now. Or you want, I don't know, I'm thinking of Mark Zuckerberg right now with Meta Platforms, that he invested a lot in VR, changed the name of the company, and he pivoted to AI, Reels monetization on Instagram. So you want a management to tell the truth, pivot, be good, and accountable to their mistakes. Okay, it was not the right decision. We will move on and pivot and do this instead. That's really important. You don't want a management that lies to shareholders. I have plenty of examples of of companies that lied to shareholders, and I would not share that with you today. Maybe on another video. You want a management with vision, passion, and execution capabilities. Yep, pretty straightforward. You want a CEO with a clear vision that knows exactly the goal, the path of the company for the next 5 years, 10 years, because it's inspiring to employees, shareholders. You want a company with passion. So think of Elon Musk. The guy sleeps on the floor in his factories. So you want somebody to live and breathe at what they do all day. If they run a company, you want them to know everything and be passionate about their companies. That is how you can find a great CEO, a great leader that will make you very rich as a shareholder. If you find this golden CEO, 1, please call me. 2, invest and hold on for your dear life, because That's how you find the next Jeff Bezos. That's how you find the next Amazon, and that's how you grow rich. Okay, and the last one is efficient and effective utilization of shareholders' fund. Yep, we talk about buybacks, dilutions. You want a management that is aware of the shareholders, and you want a management that wants shareholders to be rich, to be happy. Think of Berkshire Hathaway with Warren Buffett. They think for the shareholders. And when I went to see Berkshire Hathaway annual meeting in 2022, when I went to see Warren Buffett, we were 50,000 shareholders here in the big room, big stadium, and it was the first meeting after COVID. So there was no meeting in real life in 2020 and 2021. So it was the first one since COVID. And he said, "It's good to meet you. You are the owners, partners, shareholders." It was literally his first line, his first sentence. We, as long-term shareholders of Berkshire Hathaway, we are owners, we are partners. So that's a big step, and not a lot of management talk to shareholders this way, as partners. So yeah, you want management to be aligned, you want management to like you as a shareholder. Again, I have examples of management that don't respect shareholders, that don't care about the shareholders, and they most of the time they have a huge salary, they do many mistakes. You don't want to be a partner to these people, so you don't want to associate with these people. Okay, let's continue. You want a business with sustainable long-term competitive advantage. So that means long-term economic moats. Moats are competitive advantages. So is your business superior to competition? You want strong and clean balance sheet, a lot of cash, not a lot of debt. And you want fat margins, high margins, great return on invested capital, ROIC, and ROIC, which means return on incremental invested capital. I think that's this one. And incremental free cash flow. So yeah, you want reinvestment rates to be high. You want a long runway of high reinvestment rate. I mean, if you could have a return on investment internally, if you reinvest your cash flow every year of, 20%, like Amazon actually, 20% per year internally for 40 years, it means you can grow your earnings 20% every year for 40 years. And again, if you find this golden opportunity, one, please call me. Two, hold on for dear life. We are talking about the next Amazon. We are talking about the next Tencent. These beautiful businesses with a long runway and great capital allocation skills. And the last one is attractive valuations. Buy with MOS, margin of safety, and buy attractive business at a fair price rather than buying a fair business at unattractive prices. This is the famous quote from Warren Buffett and Charlie Munger. You want to buy a fair price for a great business that will compound for decades, instead of buying a mediocre company but at a great price. Because this is time management for you as an investor. Now this advice. If you only focus on attractive valuations for bad companies, but you buy them because they are crazy cheap, you will buy them at a margin of safety. Now it reaches fair value, so the stock goes up, and you sell. Welcome back to the hunting ground. You have to find another net opportunity, another cheap, mediocre business. And maybe that's not fun for you. Maybe you like the hunting stuff, but Charlie Munger says it's better to sit on your hands instead of being a hunter for mediocre companies. It's better to associate with greatness rather than chasing the next big thing that will go up 30% and then you sell. This kind of investing, maybe that's good for you. I mean, that can work, but that's not how Warren Buffett has invested. And as he evolved with the years, with the decades, he is much more oriented with quality businesses that you can hold for years. And I think that's it with this template. I hope that was helpful to you, and I wish you a good day. If you like this content, I have an investing coaching program to make you a better investor. In this coaching program, you will learn a complete investing process. You will learn how to find stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. So what comes with the coaching program? You will get access to an exclusive community of like-minded investors, and you will get my personal guidance to help you build the portfolio of your dream so that you can have long-term results with your stock portfolio. Click the first link in the description to get more information. You will get a 10-minute video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.